Have you considered how much income you'll need in retirement? Well, by the end of this video, I'll give you all the facts and maybe a few things that you hadn't considered to make sure that you have more income in retirement. Welcome back to Navigate Your Wealth. My name is Samantha Irish, and for the best advice on how to use both life insurance and annuities to create a successful retirement, subscribe to our channel. And don't forget to hit the notifications bell so you never miss a new video. Some people believe that they won't need as much income in retirement as they're currently earning today. Is that you? Listen, we've all heard it before. When you get to retirement, you'll only need 70 to 80% of your income. Now, why would people think that? I think the first reason is that they won't be making their retirement contributions. I've also heard I won't have dry cleaning, I won't have my commute expenses, so anything that is work-related will no longer be there. Listen, unless your dry cleaning bill is off the charts, why would you not need 100% of your income in retirement? Remember, what days right now do you spend the most money? In most cases, it's Saturday and Sunday. But when you're retired, every day is Saturday and Sunday. So do you want to be limited to your fun to only 70 to 80% of your fun? Let's assume that you say, you're right, I don't want to save for 70 or 80%, I want the full 100. But there may be something else that you're not considering. Did you know that the guy with the biggest bag doesn't always win? It's not how much you make, but it's how much you get to keep. So if you are fortunate enough to retire with a pension or to have saved a ton in your 401k or IRA, congratulations. But did you know that come retirement, those assets are 100% taxable? And once the government gets their portion, what will you be left with? Are you sitting at another 70 to 80% of your spendable income? But wait, what if there's a better way? What if you had two bags of money? If you had planned properly and your first bag of money was in that pension, IRA, 401k investments, but what if you had a second bag that was 100% tax-free in retirement? See, the problem with most people is that they're seeking immediate gratification and they want that tax deduction today when they make their contribution. But they're not considering the long-term effects of where their taxes may be. But if you plan properly and you have two bags to distribute from come retirement, you may be left with more income than if you only thought about your tax deduction today. Leave a comment in the section below and let me know if you have any tax-free income that you'll be getting in retirement. And then, after this video, check out the video titled, Why is Tax Diversification Important? We'll dig in a little bit more. Everyone understands that diversification is important, but we need to understand why tax diversification could be critical to your retirement success. Okay, let's get back to the two bags of money. Why is it that I'm saying that if you have two bags of money, you could have 23% more spendable income in retirement? Well, I keep calling it bags of money, but ultimately it's just two different types of investment accounts. One gives you the tax deduction on the front end, and the other gives you the tax benefit on the back end. Of course, that tax deduction on the front end, I'm referring to your 401k or IRA. You get the benefit when you make the contribution. So when you put the money into the account, you have no taxes that are paid on all of that money. And then the entire time the money remains in the account, it grows tax deferred. Once again, no taxes are due. But when that money comes out, it is 100% taxable at whatever the tax rate are at the time of the distribution. Now, the other type of investment is the investment that the benefit is on the back end. So in this case, we're talking about Roth IRAs or cash value life insurance. In both of these cases, you've paid the tax already because it was part of your earned income. Your contributions, there's no additional benefit to putting it in. Then, the entire time the money grows, it's once again tax deferred. No taxes are due. But the benefit comes when you take the money out, because all of that money that's in the Roth IRA or the cash value life insurance is 100% tax-free when you make your distribution. So now let's use an example of two different people. The first one wanted the immediate gratification, so they made their contributions over their savings years to their 401k and IRAs. When it comes to retirement, they will have 100% of their assets that will be taxable in retirement. Let's say from this account, they want to draw $100,000 a year. So if they take a $100,000 distribution, given today's tax rates, we're going to say that the taxable amount is 25%. So they are going to take $100,000 minus their 25% tax, which is $25,000, and they are going to be left with $75,000 a year of spendable income. Now, that's not a bad plan, especially if it's the only plan that you have. But now we're going to use person two. And this individual saved over their lifetime 50% in the future taxed bag and 50% in the tax-free bag for their future. So when they get ready to retire, they actually are only going to take $50,000 from the IRA and 401k account, and they're going to take $50,000 from the Roth IRA and cash value life insurance account. Now, on that $50,000 that's still taxable, this actually drops them down to about a 12 to 15% tax rate, which means that on the $50,000, only $7,500 will be taxable. Now, that means that of the $50,000, $7,500 is taxable, and they are left with $42,500. Now, remember, the other $50,000 is going to come out 100% tax-free. So that $50,000 has no tax and remains $50,000 of spendable income. If you take $50,000 plus the $42,500, they are left with $92,500. Now, take all the time that you want, but if you have the choice between $75,000 and $92,500, which do you choose? That $92,500 is actually 23% more spendable income that individual had because in the beginning, they thought about their future. Now, we do not know where taxes are going to be in the future. However, we know that we have a national debt that's through the roof, a government that doesn't stop spending, and we are in historically low tax rates. I get it. 20, 30% feels awful. But what if when you get to retirement, your tax brackets are now at 40 or 50%? Your situation could be worse if you don't have both bags or both investment options so that you can have more income to spend when, remember, every day is Saturday and Sunday. The truth of the matter is, when you give yourself permission to have two different taxable assets in retirement, you give yourself the ability to have more spendable income. Because remember, half of any number is always going to be a smaller number. So if 100% of your assets are not taxed in retirement, it won't matter where the tax brackets are. You will ultimately have more spendable income. If you'd like to learn how you can apply to become our client and figure out the best way for you to have more income in retirement, click on the link below. Thank you so much for watching. As always, share it with a friend, like, subscribe. We can't wait to share more videos with you in the future. And as we always say, if what you thought to be true turned out not to be, when would you want to know it? Thanks.